Hi there. Today we reveal when the sole trader to LTD switch becomes a major tax blunder in 2026. If you're planning to incorporate, this video could save you serious money.
For years, the advice for any growing business in the UK has been exactly the same. Once your profits start to climb, you incorporate. You become a limited company. It's just the smart thing to do. But what if that smart move is about to become a very expensive mistake? Well, according to the expert tax advisors at ProTax Accountant, that's a new reality a lot of business owners are facing as we head towards 2026. That's right. Because of some quiet but really crucial changes to the UK tax system, sticking with that limited company structure could actually leave you thousands of pounds worse off in the 2026 tax year. Honestly, this is a trap that's going to catch so many experienced business owners completely off guard. Now, everything we're about to walk through has been put together by the specialist at ProTax Accountant. They have crunched the numbers on the upcoming tax year to show exactly where the pitfalls are so you can make the right choice for your business. Okay, so here's what we're going to cover. We'll kick things off by looking at this 2026 trap, what it actually is. Then we'll unpack the squeeze on a director's pay and see why being a sole trader is suddenly making a comeback. The real heart of this will be a direct head-to-head comparison of the numbers. We'll also cover when a limited company is still the right call, and we'll finish up with your essential next steps. So, what is this trap then? Well, it's not one single tax rise that you might have read about. It's actually a series of freezes and tweaks that have completely changed the maths. The tax landscape for 2026 is just very different from a few years ago. The old assumptions, they just don't work anymore. And it all starts with a concept you've probably heard floating around: fiscal drag. Fiscal drag is basically a stealth tax. The government doesn't need to announce a big rate hike. They just freeze the tax bands. So, as your profits hopefully grow, or maybe just keep up with inflation, more and more of your hard-earned money gets dragged into higher tax brackets. It's this silent squeeze on your earnings that happens in the background. And right at the heart of this squeeze is the personal allowance. It's stuck, frozen solid at £12,570 all the way through to 2031. For a sole trader, every single pound you earn above this is immediately subject to tax. But, as we're about to see for limited company directors, the problem gets a whole lot more complicated. And this brings us right to the squeeze on a director's pay. You see, for a limited company, getting money from the business account into your own pocket isn't straightforward. It means navigating a bit of a tax minefield. Profit doesn't just become your money. It can get taxed multiple times along the way, creating what we call the triple tax hit. You can really see the journey your profit takes. First, the company itself gets taxed. Then, the way you decide to pay yourself gets taxed. And finally, you get taxed personally on what's left. Each of these layers takes a slice of the pie before you can spend a single penny. So let's break each one down. So hit number 1 is corporation tax. Before you can even think about paying yourself, HMRC takes its shares straight from the company's profits. Now, for businesses with profits of £50,000 or less, that rate is 19%. So right off the bat, 19 pence of every pound of profit is gone. Okay, now listen up, because this next bit affects pretty much every small business director. You'll want to hear this. To get a qualifying year for your state pension, you need to earn at least £6,708. But, and here is the trap, the point where your company starts paying employers' national insurance is now just £5,000. So the simple act of paying yourself enough to protect your future pension now creates an immediate tax bill for your company. So the crucial takeaway is this: the traditional, tax-efficient director's salary, that whole strategy, is now basically broken. That small salary that used to be a complete no-brainer for tax planning now comes with an unexpected sting in the tail. And that sting is a 15% employer's NI charge on the bit above £5,000. And then comes the final blow: dividend tax. For the 2026 tax year, the tax-free allowance for dividends is just £500. Peanuts. After that, a higher-rate taxpayer will be paying a hefty tax of nearly 36% on every single dividend. This rate has been creeping up and up, just eating away at the take-home pay for directors. So, after all that complexity and that costly process for limited companies, it's really no wonder that many people are reevaluating the much, much simpler sole trader structure. In this new tax environment, simplicity isn't just about being easier, it can also be significantly cheaper. And this really shows the difference, doesn't it? On one side, you've got that multi-stage, complicated journey for company profits, and on the other, the sole trader path. The profit your business makes is simply your income. It's a direct line with just one set of taxes to worry about. So, what does a sole trader actually pay in 2026? Well, the big company taxes are just gone. No corporation tax, no employer's NI. Instead, you just pay income tax on your profits above your personal allowance and Class 4 national insurance, which is basically a tax on your self-employed profits. It's just cleaner, simpler, and as we're about to see, it often leaves you with more money in your pocket. Okay, this is where it all comes together. We've talked about the theory, all the different layers of tax, but what does this actually mean for your bank balance? Let's put the two structures side by side and look at the real-world take-home pay. Now, you need to look closely at these figures because the results are genuinely surprising. At £40,000 of profit, a sole trader takes home over £800 more. Let's jump to the higher end. At £80,000 profit, the director is over £2,500 worse off. And at $100,000, the gap is massive. The sole trader is better off by almost £5,000. The only place the limited company squeaks a win is in this very narrow band around the £60,000 mark. Just let that sink in for a moment. At $100,000 of profit, which is a fantastic achievement for any small business owner, choosing the limited company structure could cost you nearly £4,700 in take-home pay for that year. I mean, that's a family holiday. It's a serious investment back into your business. And it's a tax outcome that goes completely against all the traditional advice we've been given for years. This catches a lot of people out. Now, after seeing those numbers, you might be thinking, right, it's an open and shut case. But hang on a minute. The decision to incorporate has never, ever been just about tax. There are some crucial non-tax reasons why a limited company might still be the absolute best choice for your business. The biggest advantage, and for many people this is the deal breaker, is limited liability. This creates a legal wall between your business stats and your personal assets, like your house. That peace of mind can be priceless. Beyond that, a limited company can just look more credible to larger clients, and it's essential if you ever plan to bring in investors or leave significant profit in the business to fund its growth. For those kinds of goals, the company structure is just far more flexible. So where does that leave us? We've seen that for 2026, the tax argument has been flipped completely on its head. But those strategic reasons for incorporating are still really strong. This isn't a one-size-fits-all answer. Making the right decision means taking a careful, honest look at your own business and your plans for the future. So here's a simple plan. First, be realistic about your profit forecasts. Where do you honestly expect your business to be on that table we just looked at? Second, weigh up those non-tax factors. How important are things like limited liability and credibility to you really? And third, and this is the most important one, get professional advice that's tailored to you. Don't rely on old advice. The rules have changed and your strategy needs to change with them. And of course, we have to say this very clearly, this analysis is for general guidance. Your own personal circumstances, any other income you have, and of course, future changes in tax law will all affect your final position. So you really shouldn't make any financial decisions based solely on this information. To get that expert, personalized analysis for your business, your best next step is to get in touch with the team at ProTax Accountant. All the details are on your screen now. They can walk you through the numbers for your exact situation and help you make the right call for your future. We really hope this has been useful, and please do subscribe for more essential updates for your business.